Hello. Today, let us look at accrued revenue. And this is revenue that has already been earned by a business but has not yet been received or invoiced. Okay. So you have already done some work. Either you've given, maybe you've given out some goods, or you've done some work that is maybe provided services. Okay. So you've completed the work, but you are yet to invoice, and you've also not received any money from the client that you are offering that those goods or services. Okay, so that is what we call accrued revenue. So we've already earned the revenue, but we are yet to receive the payment, and we are yet to invoice. Okay, so this is basically classified as a current asset. Why? Because we are expecting to receive some economic benefit in future. Why? Sorry, this is a current asset. Just showed a current benefit. This is a current asset. Why? Because we are expecting to receive an economic benefit in future. Okay, because you have already provided the services or given out the goods, we are going to get a payment, which is basically an asset in future. Okay, so we record this as a current, we classify this as a current asset. Okay, so let us look at a practical example to get an understanding of how accrued revenue is and how it occurs. Okay, so a software company completed developing an accounting software for a client in March. Okay, and the company will bill the cost of this service an amount of 2.5 million 2.5 million when they raise the quarterly invoice in April. Okay, so what is happening here? This company has already done the work, so they have done what? They have earned that revenue. We need to recognize that revenue even if they have not yet invoiced. Okay, and then once we recognize that, remember here we are recognizing the revenue, but we are yet to receive the payment. So how do we go about this? So the first thing that happens is we need to recognize these accrued revenue. Remember, I mentioned accrued revenue is an asset account. Okay, it is an asset account, and you're going to recognize 2.5 million. Okay, why are we doing this? Recall the word dealer, which guides us to know when we need to debit and when we need to credit to increase or decrease an account. And an accrued revenue is an asset account. Okay, and it's on the left side of the equation. And on the left side of the equation, we usually debit to increase that account and credit to reduce the accounts on the left side of the expanded accounting equation. Okay, so here we are recognizing an increase in our accrued revenue. This is as at end of the month of May. This is in the month of May. These are the journals you are passing at the end of May. Okay, so we are going to recognize revenue. Why? In accrual accounting, what do? We recognize revenue when it is earned. And when it is, what we mean by earned, we have done what we are required to do to earn this revenue. So we have already finished creating this software for the client. So we have earned this revenue. So we are going to earn this. Maybe we call it software revenue. It's basically a revenue account. You could just say revenue account. Okay, an amount of 2.5 million. Okay, this is us at the end of the month of May. And remember, this is a revenue account. So revenue is on the right side of the accounting equation. And when you want to increase a revenue account, you credit, which is the opposite on this side. So here we are crediting to actually recognize an increase in our revenue account. Okay, so what happens in April when we now raise this quarterly invoice? What will happen? We need to recognize something we call an account receivable, because now we have raised an invoice to the client. They are yet to pay us, but we have raised the invoice, and we are now moving this amount of money to the account receivable, because it is also an asset account. An account receivable is an asset account. That is why we are debiting to increase it. Okay. It holds what the payments that we are expecting from the client, because you've already billed them. So to them is a liability. To us, is an account receivable. To them, in their books, they're going to record this as an account payable, because they're supposed to pay us. On our end, we are recording it as an account receivable, because we are expecting to receive this amount of money that we have invoiced, okay, which is 2.5 million. And then we are going to credit what? We are going to credit accrued revenue, because as of this point now, we have raised the invoice and we have moved this to the account receivable. So when we credit accrued revenue, we are reducing it by 2.5 million. By 2.5 million. Then what happens when they pay us? When they pay us, definitely there's going to be a cash inflow into our account. So we are going to debit our cash account. We are going to debit a cash account. Remember, cash account is also an asset account. To increase it, you debit that account. So we are going to increase the cash account by 2.5 million, because now they have paid us this amount of money, and we are going to reduce the account receivable. To reduce the account receivable. Why? Because now we have been paid. We are not expecting any receivable from this. We have now been paid, so we need to reduce it by 2.5 million. So basically, accrued revenue is opposite of deferred revenue. So remember, in our previous video, we discussed about deferred revenue. Deferred revenue is when you have received the money in advance, okay, the payment in advance, and you've not provided the service. So we classify these as a current liability. Once we provide the goods or services, now we move it to become an asset, okay? Because here you've been paid in advance, but you're yet to give out the service or the goods. But now for accrued revenue, is the opposite. What is happening? You provide the services first, then you are paid later. So this is a current asset, because we have done what it is required of us, okay? What is remaining is getting that payment from the person, from the client that we have provided those services or goods, okay? And here in the deferred revenue, we have been paid before we do the work, okay? So these are just opposite of each other, okay?